Hello financial fans, welcome back to another stock analysis. Today we'll be covering CVS Health, stock ticker CVS. CVS Health is an American healthcare company that operates the largest pharmacy chain in the United States. The company offers a range of products and services including prescription drugs, over-the-counter medications, health and beauty products, and photo services. In addition to its retail pharmacies, CVS Health operates several other healthcare businesses including CVS Minute Clinic, which provides walk-in medical services, and CVS Specialty, which offers specialty pharmacy services. The company is committed to improving people's health and wellness and has been the forefront of initiatives such as removal of tobacco products from its stores and the implementation of customer-facing program to help people manage their prescription drug costs. They're currently sitting at a market cap of $113.2 billion, and in 2021 they generated a revenue of $291.9 billion, and their dividend yield is currently sitting at 2.77%. 45% of their revenue is generated from pharmacy services, 26% from retail, and 29% from healthcare benefits. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on financial ratios, the financial health, and the growth of the company. We'll be using a standard margin of safety 25% that can never be below 0%. Margin of safety can increase or decrease by the ratios that we're going to look at in just a moment. The severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, bright green will mean a 10% deduction. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction from a margin of safety. First two metrics are the EBIT growth and the margin growth. The EBIT has grown, going from $7.2 billion in 2012 to $13.7 billion in 2021. The average growth in EBIT during this period was 7.7%, meaning no change in the margin of safety. Margin has gone down, going from 5.8% in 2012 to 4.7% in 2021. The average decrease in margin was 1.9%, meaning a 5% increase in the margin of safety. Next two ratios are the dividend growth and the payout ratio. Dividends have gone up, going from 65 cents a share annually in 2012 to $2.20 a share annually in 2022. The average growth in dividend during this period was 13.7%, meaning a 10% deduction from a margin of safety. Payout ratio is sitting at a very high 93.3%, meaning a 5% increase in a margin of safety. Final two ratios that we're going to look at are the debt to EBITDA and the return on invested capital. To get a debt to EBITDA ratio, you have to take the debt, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debts. For CVS, this is 3.5 years, in this case a 347% debt to EBITDA ratio, meaning a 5% increase in the margin of safety. Return on invested capital for CVS is sitting at a nice 6.6%, meaning no change in the margin of safety. Let's go look at the valuation models next to determine the intrinsic value of CVS Health. The first valuation model that we'll be using is the discounted cash flow model. I've imported the free cash flow going from 2012 to 2021. The average growth in free cash flow during this period was almost 17.5%, and I'm projecting a 10-year expected growth of 5% annually in their free cash flow. With this percentage, we can determine the future free cash flow of CVS and determine a terminal year of valuation using a perpetual growth rate of 2% and a discount rate of 9%. Out of this, the present value of all the free cash flows are $268.4 billion, and to get an equity value, we have to add the cash and equivalents and subtract the debt, leaving us with an equity value of $204.9 billion. To get a discounted cash flow price per share, then, we have to divide it by the amount of shares outstanding, which for CVS is 1.3 billion shares, leaving us with a discounted cash flow price per share of $156.46. With the current price of $86.18, this is a massive upside of $70.28, which is an 81.5% upside. The second model I will be using is the dividend discount model. I've imported the dividend payouts from going from 4 years ago to the current year. The average growth in dividends during this period was 2.5%, but I'm projecting the expected growth rate of 7%, seeing as they were able to achieve that in the years prior to this and in the last year. In this valuation, we'll also once again be using a discount rate of 9%, and this leaves us with a dividend discount model price per share of $117.70, and with the current price of $86.18, we get an upside here of $31.52, which is a a 36.5% upside. The final valuation model that we'll be using is the multiple valuation. This valuation will be looking at similar companies to CVS Health, looking at their stock price and their earnings per share, to determine the average PE multiple in the industry, which in this case is 22.21. To get a fair value then, we have to multiply it by the earnings per share that CVS is generating, which is $2.37 a share, leaving us with a fair value of $52.63. Now at the current price of $86.18, we get a downside of this model of $33.55, which is almost a 39% downside. Let's go look at the final overview of our valuation models next. Looking at our final overview, we've imported the discounted cash flow, discounted dividend, and multiple valuation price per share, leaving us with an average price per share of $108.93. Without a margin of safety, we will get an upside of 26.4%, but we have calculated a margin of safety prior to this, using a standard margin of safety of 25%, adding 5% for the debt to EBITDA, adding 5% for the margin growth, deducting it by 10% for the dividend growth, and adding 5% for the payout ratio, leaving us with a 30% margin of safety. Applying this margin of safety, we get a fair value of $76.25. With the current price of $86.18, we get a downside of 11.5%, meaning in this case, it will be considered as a sell. If there's any other dividend companies that you would like to see me cover on this channel, please let me know, and thanks for watching.